All right, we're going to get started this evening. Welcome everyone to tonight's webinar. We're going to be discussing, Joe Fang, my colleague, and I, fund versus single assets. Which investment strategy is right for you? There's no right or wrong answer to this one. It's really just figuring out which one makes the most sense for you at this time. Like previous webinars, we're going to wait to the very end to take all your questions, but at any point you have a question, at the Q&A box, not the chat box, the Q&A box at the bottom is where you type in your question. And I encourage everyone tonight, ask away, please ask questions. Really our goal every time we have a webinar is we want you to be as comfortable as possible and excited to invest with us, especially now that we have these two great options, our new deal, Cabo del Sol, and also the Impact Fund. So always, don't worry, not going to read this verbatim, but we just have to legally flash these on the screen, the confidentiality and disclaimer, and also the financial disclaimer. And while I know many of you are familiar with us and have invested with us in the past, for those of you who are new tonight, welcome. For those of you returning, glad you're back. But those who are just not familiar with Break of Day Capital, what we do is we acquire underperforming multifamily properties, high growth areas. We focus just in the Southwest. We don't take a shotgun approach. We're just focused in the Southwest. And once we acquire them, we'll implement strong repositioning strategies, best-in-class asset management, and our goal is to maximize the values for our shareholders. Some recognition we've received recently is in 2023, the AOA, the American Apartment Owners Association, which has over 140,000 members, voted us the best real estate syndication company. And Inc. magazine has also recognized our growth. We are recognized in 2023 as the 25th fastest growing real estate company. Over the history of Break of Day Capital, we've acquired over 1,600 units and have done over 280 million in real estate transactions. So our mission statement. I know often people just glance at the mission statement and just onto the next page of the presentation or slide or a pitch deck. But I think the mission statement is quite important. It really tells you about the people you're investing with and you're trusting your money to. So our mission at Break of Day Capital is to provide passive investors with superior risk-adjusted returns with the highest level of transparency and fiduciary responsibility while implementing and improving the quality of life of our community and our residents. Our 5 core values are integrity, transparency, communication, diligence, and Kaizen. And Kaizen is a practice of continually just looking to improve yourself. Now, asset management. On this page on the right side, Gary Lipsky has written 2 books, Best in Class, which is about asset management. And he just published a new book called Invest Smart about spotting red flags in real estate syndications. These are 2 excellent reads. I highly encourage you to check them out. They're available on Amazon. We can also order them through our webpage as well. Now, the asset management part is something that we're very focused on and really is how an operator delivers alpha, really how he makes himself stand out. A lot of operators love to talk about how many deals they've done, how much capital they've raised. But the asset management is really the process of how you really create value add to your property. So that's something that we have a very strong focus on. And as I said, I really encourage you to read Gary's 2 books. So my colleague Joe Fang, who is with me here tonight, he has been investing in real estate since 2003. And you are reading that correctly. He has invested in over 50 commercial real estate syndications across all different types of different possible commercial real estate opportunities. He's invested in 6 deals with Break of Day Capital right before he joined the team in 2022. And prior to joining Break of Day Capital, he worked on Wall Street. He spent 5 years at a hedge fund in New York and 7 years with an institutional fund manager in Los Angeles. And Joe loves what he does. He loves conversing with investors, talking about real estate, talking about alternative investments. He loves macroeconomics and health. And if you're not connected with Joe Fang, I encourage you to do so on LinkedIn. You can scan that QR code, or you can just search him by name. And his email is pretty simple, joseph@breakofdaycapital.com. And his number's there right underneath that number, 850 888, and I have to take my glasses off to read the other ones, 3816. I encourage you to really connect with him and reach out. Now, I know I've spoken to many of you who are joining us tonight, but my background is like Joe's. I spent 20 years on Wall Street. However, I was at the other end of the phone. While Joe was managing money, I was on the sales side, really talking to hedge funds, mutual funds, family offices, discussing hedging strategies, stock ideas, how to option ideas. And right before I joined Break of Day Capital, I was a multifamily realtor in Arizona. I did deals throughout the state, mostly in Phoenix and Tucson. And like Joe, I love what I do. I love talking to investors, helping them realize their financial objectives, talking about what's the right decision for you, all through real estate investing, where you can get superior returns. If you're not connected with me on LinkedIn, I encourage you to do so as well. You can scan that QR code or just find me. My email, like Joe's, the same, adam@breakofdaycapital.com. And my telephone number, feel free to call or text me at any time, 602-529-2056. And with that, we're going to go into the differences between these two different investment classes, the single asset or the fund. And as I mentioned, there's no right or wrong answer. It's really about determining what is the right investment for you at this time.
All right, Adam, thanks for the lovely intro. Let's get right into this.
Yeah.
So one of the key topics, when it comes to deciding between a fund versus a single asset is diversification. Inside of a fund, the goal is to put in several assets so that your capital would be allocated, spread across different assets. Although, at least, speaking for ourselves, we have a very specific mandate. And I'll get into that in a second. Even we do get we do get variances in the performance of each on each different property. They're not all the same. So the idea putting different assets into a fund is to sort of smooth out some of the volatility that you might experience in individual assets, and then get sort of a more of a weighted average. Now, when we open a fund, we don't necessarily have all the assets that we're gonna hopefully end up with. And for this particular fund, we want to end up with between 3 to 5 different properties. So initially, when you come in, you're really betting on the operator, you're betting on the investment strategy, and you're betting on a thesis, or you're betting on this mandate, which is what it is that we're going to do. And our goal is to buy Class B, and C workforce housing, preferably with a value add component, so that we can make improvements and drive value. And so that's the idea that you're investing in a fund. Just by way of example, let's say there are 3 deals in the fund. We end up with 3 deals in the fund, and the total raise was $20 million in equity. And if the first one was 10 million, the second one was 5, and then the third one was 5, then you would basically your money, let's say you invested $100,000 into the fund, your $100,000 would ultimately be allocated 50% into the first deal, which is 50,000, 25% into the second deal, which is 25, and then another 25 in the third deal.
So the flip side of that, obviously you get great diversification in the fund. The benefit of investing into a single asset is exactly what you're getting yourselves into. You can dive a little bit more deeper into it. You can do additional due diligence on the property, and look at the returns, closer as well. So you don't get diversification in a single asset, but you do get usually a deeper understanding of what you're getting yourself invested into when it comes to a single asset. Bonus appreciation is a very big consideration for people, especially now that we're, it's, second last day of October. We're getting into the last 2 months of the year, and a lot of people out there have sold a property. They have also, they've passive income, and they're looking for tax benefits. And actually, that's gonna be our next webinar, is going to be with a CB talking about tax benefits now that we're getting to the year end. So when it comes to a fund, bonus appreciation will be based off the allocation. So that's what it's based off of. Now, right now in the fund, the first deal we closed on, Icon of Spanish Trail, gave investors 70% bonus appreciation in 2023. However, now that we're in 2024, if you were to invest in the fund, you would not get this bonus appreciation. However, new investors will be eligible to receive allocated bonus appreciation for Cabo del Sol, and the allocation amount is depending on the amount raised for Cabo del Sol in the fund.
Yeah, Adam, I'm gonna just add a little bit of clarification to what you just said. So, because the fund is open for upwards of a couple years, and we'll have investors coming at different times. So once you are allocated for the bonus depreciation that's allowed in that taxable year, that's the early investors will receive all the depreciation that was available in that taxable year. We do not reallocate that in subsequent years. That would be an accounting nightmare. So you simply later investors simply do not get to participate in the earlier depreciation. However, there is a balance of depreciation that's available for Spanish Trail in 2024 and possibly in 2025. It's not the full, it's the balance of post the 70% bonus depreciation that was given in 2023. I'm not exactly sure what that number is for 2024. It could be, I don't know, Adam, what did we say? I think it might be like 10, 20%, something like that.
Probably in the teens.
Yeah. So you will get, then in other words, the investors are coming in now will receive the balance of the depreciation remaining from Spanish Trail, and then whatever they're entitled to for Cabo, the full amount for Cabo. Okay. And then with that, speaking of Cabo, if you decide to only invest in Cabo del Sol rather than the fund, then obviously you would be only allocated or exposed to the entire economics of just Cabo del Sol, and therefore you will receive the maximum available bonus depreciation in year 2024 that we're allowed to give on this particular deal. So, and we're going to get into this a little bit deeper in subsequent slides, but just the takeaway here is that if you are a real estate investor that needs bonus depreciation or needs to maximize what's available in 2024, then probably going into Cabo directly would be more favorable. All right, so let's talk about distributions. Just like what we mentioned earlier, where your capital will ultimately be allocated to several different properties, and then you'll end up with the weighted average in each of the properties. That would also flow through to the distributions. So just to illustrate, using that early example we gave where you have 50% allocated to deal number 1, and then 25% to deal number 2, another 25% in deal number 3. And let's suppose the first deal gave a 5% cash on cash, and then the second deal gave you a 7% cash on cash, and the third deal gave you a 4% cash on cash. You would end up with a blended average of around $5,250 on a $100,000 investment in that year.
Exactly. So the other side, the single assets, Cabo del Sol, if you invest in this deal, we're anticipating giving investors a 5% annual distribution year one, increasing, following years 5.2, 5.5. Take a little dip down to 5, then back up to 7 the next year, respectively. And the distributions, though, also it's worth noting is they're paid on a quarterly basis. Is how they're wired you on a quarterly basis, the distributions. So the timeline, when you invest in the fund, some people often say, oh, the timeline's 4 to 6 years. Oh, is my money going to be tied up that long? The answer is no. So what happens in the fund is you're in a single asset, that every single asset we've acquired, we've always said the timeline is, estimates to be 3 to 5 years. And we usually give you an idea of if it's going to be closer to 3 years or 5 years. We usually have a sense there as well. So going back to the previous distribution that we've said, $100,000 investment, it's divided over, 3 deals, $50,000 towards the first, then 25 to the second, 25 to the third. The way the fund operates is, let's say that first deal that you have $50,000 allocated towards is exited in 3 years. When that happens, you'll get your principal back, the $50,000, and then the profits. So right away you'll get that back. And then when the next deal is exit, let's say it's exit year 4, same deal. You get your $25,000 back, and then the upside as well. And same with deal 3. If that's exit year 5, same deal, $25,000 back, then the upside. So your money's not tied up for the duration of the life cycle of this fund. As each deal is exited, which your money's allocated towards, you're going to get your principal and the upside back as each deal is exited.
Yeah, Adam, I want to add additional comment. I have seen other diversified funds, with other fund managers or operators where, they want to keep your money for 10 years. And the way what they do is, like, even when they have an early exit, let's say a deal that was supposed to exit in 5 years, due to favorable market conditions, maybe they'll exit in 2 years. And then they have a clause in their fund documents where they can actually take the proceeds and then go buy more deals, right? So then they can reinvest those proceeds, and it's a way for them to kind of juice the IRR and etc. But we don't believe in that. I think 10 years is a long time to hold hostage of our investors, precious capital. And so our philosophy is we want to make money. We want to give our investors capital back plus profits as early as possible. And that doesn't count until that money hits their bank account. And so we hope to, do that as soon as possible. And then hopefully we've done a good job and our investors like us, and then they'll want to just reinvest that money with us in another deal. And so with
10
that,
years is a while. That's a long time. I can
it's
imagine having
really,
money tied up that long.
yeah, it's a really long time. And then so with that, with the single asset, it's much more straightforward. We typically underwrite to a 5-year hold. But sometimes, with favorable market conditions, or if things are going better than expected, we could try to deliver a 5-year total return in a 2 to 3 year hold, which is fantastic, which would be phenomenal, sort of our internal target.
So the fees and splits, if you've looked at any of our pitch decks, you'll see that one page that tells you the different investment classes, the waterfalls, preferred returns. They're the same for both options. We have the A, B, and C class for both the impact fund and for every single individual deal we do. So the A, B, and the C classes, the A class we call the preferred class. And if you invest in that class, you get a 10% return with a monthly distribution. It's a great option for people who just really focused on cash flow. And when the deal is exited, you just get your principal back. So it's like owning a bond that yields you 10% a year with a monthly distribution. Now, the B and the C class options, the B class is for people who invest up to $500,000 with us. And in that class, there is a 7% preferred return, which, I always tell people you always want to see a preferred return when you invest in any syndication. That means they're incentivized or have to do well by you before they see any of the profits themselves. So there's a 7% preferred return. And remind people that does not mean you get 7% back every year, but that is the hurdle that we must achieve, and it accrues every year before the waterfall hits where there's a profit splits. In the B class, the profit split 70-30, 70% to investors, 30% to break of day capital, until a 15% IRR is achieved. That's a 50-50 split. And the C class, which we call the institutional class for investors who invest $500,000 or more, in that class, there's an 8% preferred return and then 80-20 waterfall, which just stays at 80-20 thereafter. And also, I was asked a great question by a potential investor today. He was asking me about hidden fees or anything in there I need to be aware of. The answer is no. We do not charge a fund management fee for the fund. All the numbers that you'll see with us are targeted distributions to you, the targeted average annual return, the targeted internal rate of return, all those are net of fees. So there's nothing hidden in our numbers at all. No, management fees for the fund.
Yeah, one quick comment for people that are considering investing in other funds. A lot of times there's actually two layers of fees. So there's one where the sponsor is being paid to run the property, and then there's another layer of fees to manage the funds. And so you're basically being charged twice, and it's not always obvious. But with somebody like us, you are investing directly with the operator, and so there's just one set of fees, and there's not multiple, certainly not any hidden fees. Okay, this is me. Other considerations. Okay, so this is a little bit of a cheat code. So I hope that the people who decided to join us tonight, this is like you walk away with this is the price here. Okay, so earlier I mentioned to you that when you invest in a fund, you're basically investing in an investment strategy, a thesis or a mandate, right? You don't know exactly what's going to be placed, what kind of assets are the actual assets that will be purchased. It's an idea, okay? So when you come in the beginning, you're basically betting on the sponsor. You're betting on our track record and our expertise. Now, there's a way to invest in assets after the fact, okay? So you can wait until some of these assets are in the fund, so you get a look back. You get to see exactly what's in the asset. You get to see how they're performing before you invest, okay? So obviously, this is a way to kind of game the system. We don't encourage it, but it's there. But there is a caveat. Because you're coming in later, you have to pay a premium, okay? And it's not some random number that we mark up. This is advised by our legal team. If you pay an annualized 8% premium fee, whatever you want to call it, you get to invest, you get exposure to a deal that you missed out on, okay? Or you didn't have capital ready. So it's kind of like you're paying a small nominal fee to come into something, to have exposure to an asset that has already appreciated tremendously, okay? And I just want to be clear, this is not money, this fee that you're paying is not money going to the sponsor. It's going to the earlier investors because they have their capital at risk from the beginning, okay? And so in order to make it equitable for all investors, we're charging an 8% annualized fee to the later investors and then that money is going to compensate the earlier investors so that, everyone's kind of on an equal playing field. Okay, So what are we talking about exactly here? So, and Adam's gonna in the next slide, Adam's gonna walk you through all the work that was done on our first asset, which is the icon on Spanish Trail. He's going to show you how we achieve this appreciation. But before he does that, let me kind of walk you through the numbers. So based on the work that we've already performed on Spanish Trail, and in hindsight, we were able to increase the property value from $33 million to approximately 40 million based on the increases in the NOI that we've been able to achieve at the same cap rate, at the same valuation as when we bought the property. And that translates roughly into a net 32% or more unrealized paper gains on the investor's capital. Okay. So you're basically paying an 8% premium going into the fund now, with these built-in 32% paper gains. So, this is like an arbitrage, right? This is like we look for these kind of situations all day, right? It's almost risk-free. Okay. So if this is not super clear to you, hop on the phone with Adam or myself, and I would be happy to explain it to you. But with that, let me turn this over to Adam so he could show you how we were able to achieve the 32% paper gains on Spanish Trail.
Yeah, so as Joe mentioned, the first deal in this fund, Spanish Trail, we estimate it's unrealized, of course, that investors are up 32%. So how did this happen? In August, Gary Lipsky approached me and my colleague Jacqueline said, I want you guys to do a case study and I want to see where we're at on this property. So if you and I spoke on Spanish Trail, you'll know that water savings, this really showed, I think it was an excellent demonstration of how good of an operator Gary Lipsky is, that a lot of people saw Spanish Trail, pretty much all of them except for him missed this big opportunity with the water savings. So when we were doing the due diligence, the water bill was exceptionally high, shockingly high, and we own properties nearby. We kind of want to know what was up. So we visited the property and realized that showers, toilets, faucets were all high usage. And by replacing them, we could get the water bill down substantially. So the toilets, by replacing them, they went from using 3.5 gallons of water per flush to 0.8. Toilets, showers, 2.5 gallons of water per minute to 1.5 gallons of water per minute. And we also had aerators to the faucets. Now, our initial estimate was this was going to reduce the water bill 50% and add $138,000 to the bottom line and increase the value to $7.6 million. Now, had $138,000 turned into $2.76 million. In multifamily, properties are valued based off of the cap rate, which is net operating income over the price. We purchased Spanish Trail at just under a 5 cap rate, and that's what you pretty much expect to be the exit cap rate. So $138,000 divided by 5% gets you to $2.76 million of value created. Well, when we did this case study in August, the water savings is running substantially higher, 75%. And this is going to equate to $195,000 boost to the bottom line. And so $195,000 divided by 5% gets you to a $3.9 million boost to valuation. Now, as August, we wanted to make sure that this was going to continue for a few months, and it has. But we used a 5.5 cap rate just to hedge a little bit, and we started using the $3.5 million boost to value. So we took the lower end of this range to be conservative. We always like to be conservative with our numbers and our underwriting. So that was the first way we saw there was huge value created already in this property. Headcount was reduced. The property was overstaffed. That another $50,000 to the bottom line. And there was an insurance claim that finally got burned off when we acquired the property, which also reduced the expenses $50,000. So between the first three items on this list, water savings, payroll reduction, insurance claim being burnt off. That boosts the value of the property $5.5 million. Now, Joe talked about the purchase price of $33 million, but the capital raise was $17.1 million for this property. So 5.5 million divided by 17.1 gets you to that 32% boost to valuation already for this property. And we're not done yet. There's still a lot more that's going to happen with this property. Pet fees have not been implemented yet. Of the 256 units, 107 have a pet in them. Pet fees usually are $30 a month. So that, roughly you riding that number to 100 times 33,000 a month, $36,000 a year to the bottom line. And we also finished the construction of privacy walls. The first 4 units just opened to an empty courtyard. And when I first walked the property, only a handful of the tenants were using the outdoor space. Well, we've added these privacy walls, and we all went to the property about 6 weeks ago. Almost all the tenants are now using the outdoor space. This is going to boost rents another $75 a month when the leases are up for renewal. So that's how we got to this big boost the valuation of this property. So we're going to take your questions soon, but our open opportunities, the Break of Day Capital Multifamily Impact Fund, Cabo del Sol, which we're going to rebrand to Icon and Midvale once the deal is closed. And if you're interested in either one of these, you can certainly scan that QR code or go to our webpage and learn more, and go to the Invest Now section for those. Now, next steps. Now, if you've are interested, we've spoken, and you've decided you do want to invest with us, you go to our investor portal on our webpage. It's in the upper right-hand corner. And on there, you just click on that. You start signing the documents. And my colleague Jacqueline will certainly inform you about wiring instructions. But if you certainly would like to talk more, you book a discovery call. You can go to our webpage, or you can email me or call me at my contact information, adam@breakofdaycapital.com. My telephone number to call or text me is 602-529-2056. And as I said before, we're here to answer your questions. Our goal always when we speak to investors is we want you to be as comfortable as possible and excited to invest with us. And the number one way for that to occur is answering your questions. So please ask away, type in that Q&A box. And I also encourage you to follow us on social media. As I mentioned about LinkedIn, we're also obviously on Instagram, Facebook, all the big ones. But LinkedIn is probably the area that we post the most on when it comes to information. So we're going to answer questions, but before we start taking your questions, Joe and I want to talk a little bit. When we were going over this presentation, one thing that I would just love to hear is, I mentioned before, not a typo, Joe's invested in 50 commercial real estate syndications, an astronomical number. I don't know anybody who's invested in that many before. So, Joe, we've gone over this. We've talked this week many times about the 2 different investment options, the fund or the individual deal, Cabo del Sol. As an experienced investor, I would just love to hear your insight. Like, what's your thought right now? You have money to invest. Which way are you personally leaning when it comes to this decision? And just want to remind investors out there, there's no right or wrong. It's really what makes the most sense for you. But I'd love to hear just Joe's input and what he's thinking personally.
Yeah, this is a great question. And it's definitely a good problem to have. So obviously, we feel very strongly about Cabo. It's a very strong cash flowing deal. It's mostly stabilized. There's a little bit of value add, but it's a pretty low risk play. So I could see why somebody, who needs to touch and see and feel everything before they put their money in. Like, I could see why somebody would just, okay, I like this deal. I know exactly what it is. I'm cool with that. I think probably the most important reason to select Cabo over the fund is if you really needed to have maximum available bonus depreciation for 2024. By investing in Cabo directly, you will be able to get the maximum that is available, which I think we estimate at about 46% of your capital. The theoretical limit for 2024 is 60%, but for this deal, we're able to give 46% of your capital. Now, in terms of the fund, this will actually be better for anybody who's either new, like have not invested in any deals with us. You basically get to pay 8% for a deal that has already increased in value by 32. I mean, and you already see how well it's executing. And so it's already been significantly de-risked, and it's already got all these paper gains, and you get to get exposure to that after the fact, right? And it's like a small price to pay, right? That's huge. And for anybody who's new, who really doesn't need a lot of depreciation at this point, I mean, you are going to receive some, within the fund, but it's just such an attractive, this arbitrage opportunity that, for me, it's like probably 9 out of every 10 cases probably should seriously consider going to the fund. And then even people who already invested in the fund, like myself, who's already experiencing the benefits of Spanish Trail appreciation and performance, like I can do more, right? Like okay, now that it's significantly de-risked, it's only costing me 8% to get 32. Like it's almost a no-brainer. So Adam, if I had to choose, I would definitely go with the fund.
Nice.
What about you, Adam?
When you were talking about sort of arbitrage and things like that, I mean, I love both these opportunities. I've spoken to countless people about both these different opportunities, and what term came to mind, because you threw a big old Wall Street term out there, arbitrage, where people like make money almost risk free. And another term came to mind too about the fund is almost like a hot IPO. That back in the day when these IPOs came, people were dying to get shares. Please, please, please give me some shares, because they knew whatever they were priced at, let's say $20, they knew it was going to open at $25 and possibly higher. That invest in the fund reminds me a bit of that, like a hot IPO. That if you put money into the fund, you already know you're up. So even with that premium you have to pay, who cares? You're gonna make more. You're already up significantly from that. So based off that, I kind of somebody held me to it. Which one would you like to do? The fund would be that one, just because that hot IPO arbitrage, that you're up already versus where your money's coming in at. But you did mention the bonus appreciation. That if you need it, that's something that definitely you should go towards Cabo, where you will get the next a huge 46%, which would be a great number for any passive income you've received so far this year.
Yeah, good points. I mean, it sounds like we're in alignment there.
Think so, yeah. Should we go to the questions? I see somebody has written us one question here. Okay, so the question is, with 195,000 saved on the water bill, would you not subtract expenses to get real value added to the property?
Yeah, Adam, I read that question. I wasn't 100% sure exactly what the question's asking, but let me make an attempt at this. So this is just more in general. So these commercial residential properties are valued like a business, right? So it's not like a single family, townhome or condo, where the valuation is really dependent on comparable sales, where the stuff that sells down, however the stuff is selling down the street, it's kind of what you can expect for your property, right? Literally, if you have two identical apartment buildings on the same block, but same condition, everything, but if one of them's making more money, it's got more net operating income, people are going to pay more for it. It's that simple. Okay. And so when Adam spoke about reducing expenses by $195,000 per year, that is the same thing as saying the net operating income has increased by $195,000 a year, right? And the cap rate is a multiple of that stream of income. So not unlike, the way people value stocks, you have earnings, right? You have a PE ratio, which is the multiple on the earnings. What we're saying here is that because we were able to increase earnings by quite a bit, and at the same PE multiple, which is the cap rate, it increased somewhere between $3.5 to $4 million just on the water savings alone. I thought your question was suggesting that you would simply add $195,000 savings to the value, to the price of the property, and that's not how it works.
So the next question somebody's asking is, how many properties are we putting into the fund? So this one, we have in our decks, we anticipate 3 to 5 properties in the fund, but what we'll see. This is, we know for a fact now there will be 2 properties in there, and it really just depends what comes along. We don't do deals to do deals. We do deals because we know we're going to get our investors an outstanding return. So it's more of a wait and see, but that's a number that we feel comfortable telling people. There'll be 3 to 5 deals in this fund. So another question that just came in, is your fund holding a preferred equity in the Spanish deal, or are you common equity in the capital stack as an LP?
You mean to answer this one, Adam?
Yeah, I don't.
Yeah,
go ahead if you want
to. Yeah, I'm not sure if I understood Moses 100%, but let me explain it like this. On every one of our deals, we have different classes of equity, right? So Adam mentioned that class A is the preferred income, or sorry, it's the preferred equity class. And what it is the preferred equity is a tranche in the equity stack, in the equity portion of the capital stack, where investors have traded for priority to the cash flows and the return of capital over common equity, but they're only getting a fixed 10% return, and they've given up the upside as well as the depreciation. Okay. Common equity is just like a regular shareholder of a publicly traded company. You get to participate in the upside and the downside. Okay, so that's how that works.
So next question coming in, while waiting for properties to buy for the fund, where is the raised equity sitting?
Yeah. So we would only raise equity as needed, right? So when we opened the fund sometime last year, we were raising equity. We were raising capital because we were buying Spanish Trail. And then we didn't have another deal for many, many months. And so we would stop taking capital. We don't need it, right? What we could do, though, is get a commitment from you, and you can leave a small deposit, and you'll be earning a preferred rate on that deposit. And then when we do have a deal, then we'll call the capital, which is kind of what we're doing now. So we have Cabo del Sol under contract. And so we are raising capital not only for the deal itself, but the portion that's allocated to the fund. If you invest in the fund, you'll gain exposure to not only Spanish Trail, but also Cabo as well. And we're going to be doing this. Hopefully we'll have another deal under contract, maybe in the spring, beginning of the year. And we'll go through this process again. We'll open up the fund, and you can invest then. But no, we're not raising idle capital and just having it sit there, burning a hole in our pockets. Like, no, we only ask for capital when we need it.
Anyone else with a question? You know, as Joe and I always say, don't be shy, please. We're here to answer any questions you have.
By the way, I do want to make a comment, thanks to that lady's question. If you have available capital, and you're looking to place it in a deal, but you don't know what to do with that money currently, we do have a separate fund. It's called a preferred income fund, where we do pay 8%, and that's paid out, that's distributed on a monthly basis. And we could talk about this offline, but it's a great place to park your money, because with the 45-day notice, we can give that capital back to you. So it's kind of like a liquid fund. I mean, in fact, it is a liquid fund. It's invested in real estate, it's invested in our deals, and it can also be sheltered by tax, or I should say depreciation. So you wouldn't need to pay tax on it, if on the distributions, if you have depreciation. So that's this is something that we came up with because we have myself included, when we're waiting in between the next, in between deals, like it's a great place to earn a nice, healthy 8% yield. And it's relatively liquid, 45-day notice, you're out. Or some of our investors actually transfer that money out of the preferred income fund into one of our future deals.
Yeah, that's a great point, Joe, too. And you're right. I mean, this last deal we've had a few people who've done that. Exactly. They had money planted in the preferred income fund. They rolled into our new offering. So the next question is, what is the minimum amount of investment? So to answer that question, we 100,000 is our minimum, but we make exceptions. So if you have a number in mind that's below that, reach out to us, and we can discuss.
All right, next question from Eileen. So for every deal you underwrite, it's offered as a single investment and as part of the fund, and you get to choose which way to go. Yes, that is absolutely correct.
Yep.
So we have this diversified fund, a real estate fund that we call Impact Fund, and in it, it's going to have a piece of every single deal that we do until the fund is closed. So it's not going to be open forever. We expect to put in 3 to 5 assets before we close it. Okay, so again, your capital will be exposed to all the assets that we put in there. But you also have the option to invest in just the deal. Again, we have some investors, that really they need to know everything about the deal that they're putting their money into, and so we certainly have a lot of those as well. But yes, at the end of the day, you get to choose.
We'll give it one more minute with the questions. Excuse me. So the question is, so it's a blended fund, but have the option to only invest in one deal.
Yeah, so we have 2 separate structures, financial products. One is a fund, one is a diversified fund. And if you invest in just the fund, you will ultimately gain exposure to all the assets that we put in there. But those same assets can also be invested in just as an individual product, if you will. So you have the option to invest. Now, there's a caveat. On the deals that we have already closed and raised capital for example, Spanish Trail, you can go back and invest in just Spanish Trail by itself, right? Because we're not raising it for any more. But there's a backdoor way to gain exposure to Spanish Trail, right? Which is what we talked about earlier with the arbitrage opportunity, where you can pay a small fee, a small premium to get into the fund, and get exposure to Spanish Trail.